Hi, I'm Max Keiser. This is the Keiser Report. Ever wonder why Bitcoin is going like a rocket ship? Let's talk with Stacy. Stacy?
Yeah, I like the mainstream economists that are allowed to go onto CNBC, Bloomberg, and all those other financial news programs and fret about the price of Bitcoin and what Bitcoin's doing when it is the only safe harbor, as Max and I have pointed out now for almost 10 years, from government printing and quantitative easing and other exotic sort of programs introduced over the past 2 decades. And you see why we might be concerned out here in the Bitcoin community. A grim look at the exploding U.S. budget deficit. Look at these charts, Max. So this is the long-term outlook right now for government debt. And apparently, according to the Congressional Budget Office, it could hit 202% if things go well for us by 2051. If things don't go well, it will hit 259%. The public debt will be 259% of GDP. And the bad outlook, like where they think it might go wrong, is like it's going to go okay if we stick to, like, we don't do anything else. Actual budget deficits could be higher under CBO projections under an alternative scenario that assumes lawmakers enact an additional $2 trillion of fiscal support in response to COVID-19, similar to the American Rescue Package that just passed last week or the week before, extend most expiring tax cuts, and grow annual appropriations with the economy instead of inflation. Debt would total 259% of GDP by 2051.
Hey, we're catching up to Japan. I think they're almost at 300% debt to GDP, and the whole world is over 200, probably closer to 250% debt to GDP. Can I explain the problem of this, what the real issue is here? Because a lot of people in the New York Times, like Paul Krugman, say, don't worry about it, it's just money we owe ourselves. Can I explain what the problem is?
Yeah, go ahead.
Right, so in order to sustain this huge debt load, you have to keep interest rates near 0%. And the access to those 0% interest rates, it's a political cronyism. It depends on political connections. And that's the transformation of America from a market-led economy, a free market-led economy, to crony capitalism. Because the entire economy, since it's mostly debt, as you're pointing out, 2, 3, 4, 500,000% debt to GDP, it's all about who has access to the cheap interest rates, the 0% interest rates. And that increasingly are this oligarchy of kleptocrats. And then what they do with that credit availability at 0% is that they would buy other competing companies and end up with a huge concentration of wealth. You know, a great example is the ECB, right? They loaned the head of Louis Vuitton, LVMH, money from the central bank at 0% interest rate to buy Tiffany's, right? So they went and bought Tiffany's for free. So now that luxury brand, that company's hugely a concentration of wealth. So for those who don't think this is a problem, they're wrong.
Yeah, and you know, when they compare it to Japan, however, like Japan had a really high savings rate, okay? The domestic households had a high savings rate, and that was like money they owed to themselves in that their savings was in yen. They were buying up the treasuries from their government, the Japanese government bonds. So, you know, it was within their own economy, whereas we have a huge no savings rate here in America. So therefore, foreigners used to buy it, but now it's just the Fed. So it's just, it's money we owe another branch of government, not based on any savings that actually happened.
Right. In Japan, they have a pension. The public pension fund is enormous, similar in size to the debt load. And they're where they don't expose that pension pot to their equivalent of Wall Street to go lose it. Probably what's going to happen in the United States is that they're going to let Wall Street manage America's Social Security Fund, which is about $3 trillion. And they'll give it to BlackRock or somebody like that to increase returns. And then they'll gamble it away and lose it, as usual.
Right. So I'll show you another chart because it's just scary. So remember, the public debt is the accumulation of all the deficits over the decades and centuries of the founding of this nation, especially if it doesn't get paid off. So sometimes, rarely in the past few decades, have we had a budget surplus. I think that last time was under Clinton. We had a small surplus under him during the dot-com boom. Well, we don't have surpluses anymore. I remember in Europe, everybody, that fiscal number, the number of the budget deficit you're allowed to have is 3%, right? So just put that into context. First I'll show you the chart because it looks scary. This is where we are now. Our budget deficit was very high in 2020. The CBO projects it's going to decline. I don't see how that happens for a bit, but then soar. So what the actual numbers are, budget deficits had already risen before the pandemic from 2.4% of GDP, which was $442 billion in 2015, to 4.6% of GDP, which was $984 billion in 2019, and set a new record of 14.9% of GDP last year, which was $3.1 trillion due to the crisis. The CBO expects the deficit to fall to just $2.3 trillion this year and hit a low of $905 billion in 2024 before resuming its upward trajectory. The deficit is projected to total 5.7% of GDP in 2031, 9.4% of GDP in 2041, and 13.3% of GDP of $8.8 trillion in 2051. And just so you know the actual number of what the debt is they project in the good times, if things go well, by 2051. So right now, our total public debt is 28 trillion. And by 2051, they project it will be 133 trillion.
I have 2 words for you.
Shut up.
No. No. 2 words. I've seen this movie before. Boris Yeltsin. Go back and look at your history. Oligarchy flourished under a guy who was barely able to walk down the street. Here we have in the US somebody who's cognitively impaired. That's pretty common wisdom. Overseeing the rise of an American oligarchy assisted by 0% interest rates that allow for the kleptocrats to own all means of production. We've seen it before. We know how it ends. Sad to see, but that's the way it's going to be.
Well, certainly the currency is going to be trash. And it does seem like an end game. As you pointed out earlier, we've had an extended pretend for 40 years, and now it's reaching the end game. So in terms of the spending projections, what the CBO projects our spending will be and why it'll be impossible to pay down any of this debt is the projected long-term growth in spending is largely driven by rising health care costs, obviously, interest, and retirement costs. The CBO expects spending in these 3 areas to rise from the current 12.3% of GDP this year to 24.4% of GDP by 2051. Interest spending will be the largest federal program by 2045. And that is why we can't have interest rates rise, because this is just on low interest rates right here, where they're saying that it's going to be the largest, even at these low interest rates, it's going to be the #1 line item in the budget in 2045.
Right, which is a really bad assumption to make, because all this money printing is leading to a loss of confidence in the US dollar as world reserve currency. And we have an incredible signal right now telling us this is true with Bitcoin. The US dollar right now is in a hyperinflationary collapse against Bitcoin. It's a big signal. Bitcoin is not the bubble. Bitcoin is the pin. The US dollar is the bubble. Now, once the bubble pops, and if in fact we are at the end of a 40-year bull market in bonds, that means US dollar as world reserve currency ends and the bubble pops in the bond market. Interest rates are going to go from, let's call it 1.6 on the 10-year bond to 5, 6, 7%. So a 5, 6, 7x higher rate. So that projection is not going to be in the 2040s. It's going to be in next year. Next year, I predict, not 2040. It'll happen next year.
Yeah, and you see that like the moment the very first stimulus checks and the latest round of stimulus checks hit the bank accounts, literally Bitcoin started to soar. So it is the acting as that bond vigilante that used to exist before the central banks crushed them. or the gold bugs. Gold used to rise whenever this sort of thing happened, but now it's just Bitcoin is the only one. And, in terms of a crumbling empire, if you look back through history, you often see, well, the bread and circuses. So we've had circuses for the last 40 years, and now they're getting the bread, right? All the free stimulus is being thrown into their bank accounts. That's the first time we've seen that sort of stimulus happening in America since in our lifetimes. Like, you've never had like thousands and thousands of dollars just poured into, I have a lot of family with thousands of dollars that they never had just being poured into their bank accounts. But at the edge of empire is where you start to see the, the movements away. They're safe distance away, and they start exiting the dollar or preparing for, the collapse of that central currency or the power structure. And I saw this headline from South Korea's crypto exchange market volume surpassed the nation's stock exchange market. This is quite insane, Bitcoin. So this is that stampede, anything to get out of fiat currencies. If, it's just the instinct that a collective of people, like thousands and thousands of millions and billions of people, sense something's amiss, something's going to happen.
Right. This is the first time possibly ever that the U.S. has resorted to the bread and circuses with the emphasis on the bread. We've had the circuses, and now they're just pumping cash directly into people's bank accounts. And the rest of the world sees that, and they're like, why am I working like a dog 100 hours a week in a factory somewhere in Asia so that Americans can buy these goods with that funny money that they're just printing by the hundreds of trillions of dollars? Maybe we should just cut them free, and let's keep our economy more domesticated. That's part of the deglobalization trend that we called as one of the big trends for 2021. And that would further collapse the US dollar, jack interest rates higher, and the interest on the debt wouldn't be a problem in the 2040s, but in 2022, that would be next year.
And for the past 40 years, we've had all circus, no bread. And now we have all bread, no circus, because the circus has, of course, been deplatformed because all the cartoon characters, all that stuff, like everything is against the woke ideology. So it's all bread, no circuses. Biden really had no choice because people are sick of circuses and they want the bread.
Pour one out for Pepe Le Pew. We're going to take a break. And when we come back, much more coming your way. Welcome back to the Keiser Report. I'm Max Keiser. Time now to go to Michael Pento of pentoport.com. Michael, welcome back.
Thank you for having me back on the program, Maxwell.
Yeah, my pleasure. So you're a money manager that's agile. You're making money in up markets and down markets. You've got a very strict discipline to your approach. It's working fantastically well. I understand you're deluged with clients, and rightfully so, because you do a great job. And we need to pick your brains on something here. Bank of America report this week suggests that the 40-year bull market in bonds is over. Your thoughts?
Well, I think temporarily, for sure, we are in the middle of a bond bubble meltdown. And when I say meltdown, I mean, you're going from 0.3% at the nadir up to probably low 2% by May, June timeframe. And that's probably going to cause some angst in the credit markets, and it's going to cause some angst in the emerging markets. Tremendous amount of dollar-based debt, and I think you might see a temporary flight into the dollar and a mini crisis, but in the stock market, equity market, and of course the fixed income market. But what I think on the other end of that is going to be a continuation of the bond bull market, because what we have engendered here is a tremendously unstable economy predicated on artificially low interest rates and asset bubbles. We know this. And we're going to have times of severe booms and severe busts in the economy and in the markets. So what you're seeing now is a boom predicated on the fact, Max, that the US government borrowed $6 trillion year over year from March of 2020 to March of 2021. $6 trillion, $5 trillion of which will be printed by the Federal Reserve. So yes, you're having a surge in growth. You will have a surge in inflation. a surge in nominal interest rates. And then you're going to have a massive fiscal and monetary cliff later this year and into 22. And I think that's going to cause another cyclical bull market in the bond market.
So the answer is, in your view, the Bank of America is basically wrong because they're calling for the end of a 40-year bull market and the beginning of a secular bear market in the bond market. So you're anticipating more of the same. There'll be a crisis in the markets, which will be responded to by another massive purchase of bonds by the central bank. So you mentioned $6 trillion year on year printed in the last 12 months. And we know that since 2008, there's been 17 or 18 trillion or more printed to try to keep these insolvent banks up and running. So how much can they go? Is there any limit? Can they go 30, 40 trillion? Where's this going?
Well, you're running into a bit of a problem with the dollar here, Max. You know, the dollar is a heavily shorted instrument right now. It's all one-sided trade. And like I said, if you see the 10-year note rise, I use the benchmark treasury note as my proxy for the long-term interest rates. If it rises quickly and intensely in duration between now, excuse me, and in June, you might see a collapse in equities worldwide, which always leads to a surge of money coming into the dollar as they repatriate those carry trades. And it will lead to a boom in prices for bonds. So you'll see a huge reflex where bond yields skyrocket, bond yields skyrocket, prices collapse, and then you'll see the reverse of that trade probably later this year. That's what we're headed into.
I know one often quoted indicator would be the so-called Buffett indicator, where stock market valuation as a ratio to GDP. And I believe we blew past that number a while ago. You're shaking your head, so I guess you follow that a little bit. Where are we on those types of valuations? How bloated is this market?
Well, I'm shaking my head because Stacy told me not to interrupt you, so I'm trying to listen to her. And being an Italian, it's very hard to do that. You know, I like to talk with my hands and interrupt people all the time. But what I was agreeing with you in the Amen chorus over here is that the Buffett indicator, if you look where it was in 2007, it was basically 100% of the underlying GDP. Today, it's 195% of the underlying economy. So we had a massive, unprecedented bubble in equities. And it's held together by what? Low interest rates. And what's happening, Maxwell, right now? It is the end, in a cyclical basis, of that quiescence where you see, we have very low growth and very low inflation. So the Federal Reserve can print money willy-nilly, and the government can borrow and spend money ad infinitum, without end, amen, and it will cause no problems in the stock market. But look what happened to the high-flying tech stocks recently. Some of them down 40%, if you look at the Zooms and the Pelotons, because everybody was sequestered into this one trade, the growth, heavily owned, stay-at-home trade called the NASDAQ tech trade. And everybody got out of that at once and caused it to crash. Where you're going to see many more crashes like that between now and, say, May, because the pressure upward on yields is going to be absolutely overwhelming. Year-over-year growth rates are going to blow the doors off of any estimates. I'm looking at probably set for the whole year, 7% GDP growth. Year-over-year, is going to be something we haven't seen since outside of right after World War II. And you're also going to see inflation, because you cannot tell me you can hand out $1,400 checks to, the vast majority of Americans, and then more enhanced unemployment. The government has handed out, as I said, $6 trillion to state and local governments, corporations, individuals. That money's all been printed and handed out to people and the economy, the private sector. And that means you're going to have a massive spike in growth and inflation, followed by what I call this unprecedented fiscal cliff. So basically, if you're not an active manager, if you're going to sit there and say, I always think this, I always think the dollar is going to go down, I always think tech stocks are going to be in vogue, I'm always going to buy China, whatever your mantra is, it's not going to work. It's going to work sometimes really, really well, and other times it's going to crush your portfolio.
Well, we've mentioned stocks, bonds, cash. At the moment, in your managed accounts, what's your heaviest allocation?
Heaviest allocation in the managed account right now, we have a bet on a widening yield curve. So we have a quadratic fund that bets primarily on interest rates from the 2-10 spread increasing. We are short bonds. We are actually long banks, holding my nose, and long banks because banks do well as the yield curve, yield spread increases. We also are long the dollar, Max, as I said before. And none of these positions here is what I'm comfortable owning. This is not something where we set it and forget it. This is not the way we manage money here at Pento Portfolio Strategies. This is not a set it and forget it portfolio. We will probably be very much long duration bonds in the summer and probably also be short stocks in the summer if my theory is correct. Because sooner or later, this is the scenario that's going to occur. Either we're going to continue to borrow and print trillions and trillions of dollars every year, and that's going to cause the bond bubble to burst. Make no mistake about it. We are in a bond market bubble, absolutely. Or they stop printing money, and the only buyer, indiscriminate and unlimited practically, buyer of treasuries yielding 1.6% goes away. And that's going to cause asset prices to absolutely collapse. So we are in for a lot of trouble. And it's unfortunate, but what happens when you have central banks and governments usurp markets, obliterate them, vanquish them, annihilate them for years and years and years? What happens is you can never extricate yourself from that. And you cause a lot of unintended consequences, one of which we're seeing right now, which is going to be a huge spike in bond yields.
At the moment, and this can change at any moment, as you suggest. It's not set it and forget it. It's very dynamic. You've got live indicators, and you respond in real time. But at the moment, you're saying you think you can squeeze one more rally out of the bond market before the big comeuppance comes to that market. Let's talk about one of your competitors, I guess you could call it, or one of your brethren, Stan Druckenmiller. He says he's very short the dollar, and he's long Asia and commodities. It sounds like you're thinking along similar lines, Michael.
Well, not right now. I mean, I'm actually long the dollar right now, so I have a tremendous amount of respect for Stan Druckenmiller. But let's just look back in history. What happens when you have a global crisis? What are the things that happen when you have a global crisis? Well, we know for sure what happens. First thing happens, people rush in to unwind carry trades. So they borrow the dollar, they short it, and they buy stuff overseas that has higher growth rates and higher returns, be it bonds or equities. And then when the problem hits the fan, when the U.S. catches a cold, the U.S. catches a fever, the entire world gets deathly ill. And then people unwind their carry trades, and they rush back into the dollar, and they rush back into short-term treasuries. So I will own those two things when the problem hits. I also will short equities. So you think about long the dollar, long short-term bonds, long cash, and short equities. That will probably be my portfolio if the situation plays out the way I see it. When the fiscal and monetary cliff, when the economy starts to toboggan down that slide.
To be clear, I misspoke. You, in fact, are taking a position very much different than Stan Druckenmiller. Well, one little question. He's got a huge fund. Does that impair his ability to deliver numbers? Does size become a mitigating factor when you're managing money like that? I take it that one of the attributes you've got over there at Pento Portfolio is that you're just sticking to that maximum bang for the buck where you can squeeze out alpha or return without having to worry about moving markets, which of course Stan Druckenmiller has that problem because he's so huge. He's also long gold. Any thoughts there?
Two thoughts is that, the more money you manage, hundreds of billions of dollars, you're obviously going to move markets when you make changes. So, I don't have to worry about that. I manage over 100 billion. I don't manage 100 billion. So that's one thing. Number two, I sold my gold, all of it, a few weeks ago, and I sold the miners about 6 months ago. And the reason why I did it, I was very clear. I said we're heading into a period of rising real interest rates. In other words, nominal rates will be rising faster than inflation rates, which is always the death for gold. And you can see the way gold trades, it trades as real money. And when fiat dollars pay more and more interest rates, gold gets hurt.
All right, Michael Pento, still in the game, hungry for alpha, giving people returns that they love. Thanks for being on the Keiser Report.
Thanks for having me back on, Max.
All right, that's going to do it for this edition of Keiser Report with me, Max Keiser, and Stacy Herbert. I want to thank our guest, Michael Pento of pentoport.com. Until next time, bye, y'all.